What is the Federal Reserve and how does it affect you? Hey everyone! Have you heard people talking about the Federal Reserve or the Fed and wondered what exactly it is and what it does? If so, then you've come to the right place. In this video, we'll explain what the Federal Reserve is in simple terms, how it impacts interest rates and the overall economy, and why it's so important. This topic can seem complex, but I'll break it down step by step so it's easy to understand. Whether you're interested in business, finance, economics, or just want to be an informed citizen, stick around to learn the basics of the powerful entity known as the Fed. What is the Federal Reserve? First things first, what exactly is the Federal Reserve? Simply put, the Federal Reserve is the central bank of the United States. It was created in 1913 to serve as the banker for the U.S. government and regulate the banking industry. The Federal Reserve is tasked with two main objectives: maximizing employment and stabilizing prices. By promoting these two goals, the Federal Reserve aims to foster economic growth and stability. The Federal Reserve is comprised of 12 regional Federal Reserve banks located in major cities around the country. It's governed by the Federal Reserve Board of Governors, which consists of 7 members nominated by the President and approved by the Senate. While the Federal Reserve is subject to oversight by Congress, it operates independently when making policy decisions. This independence is meant to isolate Fed policymaking from political pressure. How does the Federal Reserve impact interest rates? Now that we know what the Fed is, let's discuss one of its major responsibilities: setting interest rates. The interest rates set by the Fed influence the rates you pay on your mortgage, credit cards, and other loans. Specifically, the Federal Reserve controls the federal funds rate. This is the interest rate banks charge each other for overnight lending. The Federal Reserve primarily adjusts the federal funds rate through open market operations. This involves buying and selling government securities to influence the availability and cost of money. For example, when the Fed buys securities, it injects money into the economy and lowers interest rates. Conversely, selling securities removes money from the system and raises rates. Changes to the federal funds rate go on to affect long-term rates like mortgages. Generally, when the Fed lowers the federal funds rate, banks can pay less to borrow money. They pass those savings along to customers through lower interest rates on loans and credit cards. This makes borrowing cheaper, driving more spending and economic growth. How does the Federal Reserve impact the economy? Not only do interest rates impact your wallet, but they also influence the overall economy. The Federal Reserve uses monetary policy, including adjusting interest rates, to maintain a healthy rate of inflation and keep unemployment low. For example, if the economy is struggling and unemployment is high, the Fed may lower interest rates to drive more borrowing and spending. If the economy is overheating with high inflation, the Fed may raise rates to cool things down. Beyond interest rates, the Fed has other tools to stabilize the economy. This includes influencing the money supply through quantitative easing or tightening, as well as setting reserve requirements for banks. The Fed monitors macroeconomic indicators like GDP, unemployment, and inflation. It leverages these tools to accomplish its dual mandate of maximizing employment while keeping prices stable. I hope this video helped explain what the mysterious Federal Reserve is and how it impacts your everyday life. By managing interest rates and the money supply, the Fed plays an important role in regulating financial markets, influencing inflation, and ultimately shaping our economic health. While its workings can seem complicated, just remember that the Fed is continually working in the background to steer the economy in a positive direction for all Americans. Be sure to subscribe for more breakdowns of complex financial topics.